Okay, let's unpack this. We're diving deep today into NG's Q1 2025 earnings call.
That's right.
We've got the results, management commentary, the whole 9 yards. Our mission, as always, is to cut through all the corporate speak and numbers to pull out what you really need to know.
Yeah, what actually matters.
Exactly. What are the key results? What did management say was important? And what does it all mean in the context of the energy world right now?
Think of us as your guides through the data maze. We've been through the earnings slides and transcript to highlight the moments of genuine insight and, tell you why they matter.
Perfect. Let's start with the big picture snapshot from Q1 2025. How did the numbers land?
Well, the headline number everyone looks at, EBIT, excluding nuclear, came in at $3.7 billion.
Right.
That's up a solid 2% compared to Q1 2024.
Up 2% right out of the gate. And cash flow.
Cash flow from operations, or CFO, stood at $4 billion for the quarter.
Right.
On the balance sheet side, they saw economic net debt actually decrease by 4% over the quarter, landing at $46 billion.
$46 billion. What does that mean for their leverage, the ratio?
Yeah, good question. It puts them at 3.0 times EBITDA. Crucially, that's comfortably below their stated ceiling of 4 times.
Okay, so well within the guardrail.
Exactly. So balance sheet strength seems to be holding up.
Good to see the leverage in check.
Yeah.
What about the outlook? Are they still on track for the year?
Yes, they confirmed their full year 2025 guidance for a net recurring income group share. They're still targeting between $4.4 billion and $5 billion.
Right.
They express confidence in hitting that range, citing the strong Q1 start, but, acknowledge the familiar theme of macro uncertainties hanging out there.
Always the macro uncertainties. All right, time for the deep dive into the financials. That 2% increase in EBIT ex nuclear. You mentioned it was up $77 million organically. What were the main drivers behind that organic growth?
Right. The organic picture is really where you see the operational performance shining through or not. And here we saw positive contributions from volumes and new assets coming online. Colder temperatures in Q1 boosted volumes by 92 million, which actually more than offset less favorable hydrology compared to last year.
Huh. Colder weather actually showing up clearly in the bottom line. Interesting.
It really did this quarter. And commissioning new assets, mainly renewables and flexible power in North and Latin America, plus some network investments, added another $82 million to EBIT.
So physical assets working hard, weather helping out volumes, and new capacity coming online were key positive drivers then.
That sums it up nicely. Those were the main lifts.
Got it. So operations and new projects driving a chunk of that organic gain. What about things like prices, volatility, or external factors like currency? Those must have played a role too.
They did. FX and scope changes were actually negative overall.
Great.
Notably due to the Brazilian real depreciating and some asset sales they've completed, like in Portugal, Morocco, and the Mexico pipeline sale.
Right.
Prices and volatility had a limited overall impact, slightly negative at minus $74 million.
How can it be limited overall but still negative? That sounds a bit contradictory.
Yeah, it does, but it's a bit of a mixed bag playing out underneath. Prices and volatility had a negative effect in the B2B and energy management segments,
Okay.
but a positive effect in networks and B2C. So different parts of the business reacted differently, almost canceling each other out on the whole, but leaving that slight overall drag.
I see. So pushes and pulls across the segments.
Exactly. Performance initiatives they've been working on, their internal efforts, added a positive $72 million, which is a solid contribution from within the business.
Okay, summing up the organic piece then, it sounds like operational performance and commissioning really offset some headwinds from FX, scope, and that mixed market volatility picture.
That's the takeaway. They got good lift from volumes and new assets that managed to cover those other drags, and the internal initiatives helped too.
Shifting gears slightly, what about the nuclear segment's performance? How did that fare?
Nuclear EBIT was down $55 million, landing at $406 million.
Okay, why the drop?
The main reason for the decrease was the planned shutdown of Doel 1 in Belgium on February 1st, 2025. Even though the other assets had good availability, losing a whole unit obviously impacts production and earnings.
Makes sense. Let's talk about that cash flow again. You said CFO was $4 billion, but it was down $1.1 billion year on year. That sounds like a pretty big drop on the surface. What's the story there?
Yeah, this is where you definitely have to look beneath the surface. On the one hand, operating cash flows before working capital actually increased by 900 million, though that number includes some reclassifications compared to last year, so it's not perfectly clean.
Okay.
The big swing came from working capital movements.
Working capital.
Yes.
Always the source of potential confusion. Can you unpack that difference year on year for us?
Sure. Think back to Q1 2024. That quarter saw a huge positive impact of 1.6 billion from working capital.
Why was that?
Because energy prices had normalized significantly after the crisis highs of 2020-2023. So cash that had been tied up in things like margin calls was released back into the business.
Right. A big unwind.
Exactly. Now, fast forward to Q1 2025, working capital levels are more, let's say, normalized, and you saw a negative 0.4 billion impact this quarter.
Okay, so the comparison is totally distorted by a massive cash release in the prior year period.
Precisely. That's a 2 billion swing right there in just the working capital line when you compare the two quarters.
Oh, okay.
And on top of that, they saw a negative 800 million impact year on year from margin calls related to March deliveries and the effects of European gas prices. So the lower headline CFO wasn't really an operational cash generation issue as much as it was a comparison against that period of unusual cash release and some specific timing impacts on margin calls this year.
That makes a lot more sense. Thanks for clearing that up. Speaking of big financial items, the closure of the Belgian nuclear waste agreement, that was a massive transaction. What was the balance sheet impact?
Yeah, huge. This was a major de-risking event for them. They transferred the significant Category B and C nuclear waste management obligations over to the Belgian government. On the balance sheet, this translated into a 12.2 billion decrease in their nuclear provisions. Huge number. And they made a corresponding payment of 12 billion to the government.
Where did that 12 billion payment come from? Did they just have that lying around?
Not quite. Primarily from monetizing 9.5 billion of dedicated financial assets that were specifically set aside for this purpose over many years. Plus, they used 2.6 billion in cash from their balance sheet.
And the impact on their debt metrics. Did economic net debt drop by 12 billion?
This is a key point. The transfer of the liability itself had no impact on economic net debt.
No impact. Why not?
Because that 12.2 billion obligation was already fully booked as a liability before the transaction happened. It was already part of their economic net debt calculation.
Right. It was already accounted for.
Exactly. However, the 2.6 billion cash portion of the payment did increase their net financial debt because that was actual cash going out the door.
Okay, so economic net debt wasn't affected by the transfer itself, but net financial debt increased slightly due to the cash component. What nuclear provisions are left on the books now?
As of the end of March, about 3.6 billion in nuclear waste management provisions remain. This is for the Category A waste, the less problematic stuff.
And what happens with that?
This remaining obligation is expected to be transferred to the government when the long-term operation reactors, Doel 4 and Tihange 3, restart, which is planned for Q4 2025.
Right.
At that point, those reactors will operate as quasi-regulated assets within the new joint venture they've formed with the Belgian government.
So wrapping up the debt picture then, net financial debt went from 33.2 billion to 34.6 billion, largely due to that nuclear funding cash component.
Correct.
But economic net debt actually decreased by 1.8 billion because that big nuclear liability was already factored in before, and other factors helped reduce it slightly quarter on quarter.
That's right. And importantly, their leverage ratios remain strong. Net financial debt to EBITDA is sitting at 2.2 times. And economic net debt to EBITDA is 3.8 times, both well within their comfort zone, significantly below that 4 times ceiling they target. That gives them flexibility.
Definitely. They mentioned on the call, they see themselves as having a kind of unique cash generation position.
Yeah.
What's the logic there? What makes them unique in their view?
Yeah, they highlighted the mix of their businesses. They've got growing cash flow from their renewables and flexible power portfolio, which they are obviously reinvesting heavily in.
Right, the growth engine.
But they also have their infrastructure business, particularly the gas networks, which provides very stable, significant cash flow with crucially limited growth capital expenditure requirements compared to the cash it throws off.
Okay, the cash cow.
Sort of, yeah. And then there's supply and energy management, relatively low capital intensity, but generating sound cash flows from customer sales and market activities. So it's this diversified, balanced cash profile from these different types of businesses that supports their investment grade rating and, importantly for investors, their dividend policy.
Makes sense. Moving from the numbers to the operations and strategy side, how did the renewables expansion progress in Q1? Any big milestones?
Yeah, steady progress. They added over zero point 0.6 GW of new capacity, primarily in Latin America and Egypt, pushing their total renewables and storage capacity now to 51.6 GW.
Okay.
They also reported good progress on construction, with 8.5 GW currently underway across 101 projects. They made a point of emphasizing efficient execution on those buildouts.
Any new additions to the portfolio via acquisition? Seems like M&A is always bubbling away.
Yes, two notable ones pending final approval. They agreed to acquire two fully contracted hydro plants in Brazil, totaling 612 milliamperes.
Hydro in Brazil. Interesting.
Yeah, this deal really solidifies their position as the leading private hydro generator down there. The other one is an operating onshore wind and solar portfolio in the UK, 157 milliW across 7 sites.
And what's the angle on the UK one? Just operating assets.
Well, operating assets for now, but they specifically mentioned seeing potential there for adding batteries or maybe more solar or even repowering existing sites down the line. That's attractive given how complex and lengthy new permitting can be in the UK.
Right. Leveraging existing sites makes sense. They also had a Power Networks win in Chile. What was that about?
Correct. They won a tender for a new substation north of Santiago. Management pointed to this as an example of leveraging their integrated position in Chile, where they have renewables, storage, PPAs, and now adding more transmission infrastructure to connect it all.
Gotcha. The new business organization, that big internal restructuring, was implemented in February. Was there any impact seen already in Q1?
They reported a positive performance impact of $72 million attributed to the new structure in the first quarter alone.
Already? That's pretty quick.
Yeah, they see it as a first step towards their bigger target of achieving a $1 billion plus boost from this organizational change over the 2025-2027 period. The whole goal is to simplify, unlock synergies, be more agile, and better seize opportunities.
And streamlining also involves divesting non-core assets.
Right.
Where are they with that?
Absolutely. They're continuing to chip away at exiting non-strategic parts of their former energy solutions unit. This quarter, that included getting out of gas generation assets in places like Kuwait, Bahrain, and Pakistan.
Okay.
They also reduced their stake in the Safi coal plant in Morocco down to just 18%, basically converting it into more of a financial investment rather than strategic operational control.
What's left of their coal exposure after all that? Getting close to zero.
Pretty close. Their only remaining operational coal assets are in Chile, just under 1 GW capacity, and they have a firm plan to exit those completely by 2027 at the latest.
Okay. We mentioned the Belgian nuclear transaction before, but management really called its closure a major milestone. Why is that so significant strategically beyond just the numbers?
It fundamentally de-risks the balance sheet regarding those very large, very long-term waste liabilities. It removes a major source of financial uncertainty that had frankly been hanging over the company for years.
So frees them up mentally almost.
Exactly. With that resolved, management can now put their full focus squarely on executing the core strategic priorities: renewables, networks, flexible generation, customer solutions. The initial $12 billion payment is done, with the smaller remaining amount for category waste tied to the restart of Dole 4 and Tihange 3 in November 2025 under that new JV structure. It just clears the decks.
Right, clears the decks. Let's pivot to the investor context now, particularly a big topic on the call. The U.S. situation, tariffs, the IRA, it feels like a constantly moving target there.
Yeah.
How is NG navigating that dynamic environment?
It is definitely dynamic, you're right. But management stressed they had already taken proactive steps to de-risk their exposure to potential tariffs before the latest administration actions came down.
Okay. How?
Well, first off, their operating fleet of 8.5 GW in the U.S. is simply unaffected. Those assets are built and running.
Okay, operating assets are fine. What about projects they're currently building? They have 2.0 GW under construction in the U.S., right? Including a lot of batteries.
Correct. For those, they feel largely protected. For the 1.3 GW of batteries under construction, they proactively sourced and actually reallocated batteries bought back in 2024 specifically to these 2025 projects to ensure they met the safe harbor protection deadlines under the IRA rules.
Smart move.
Yeah, good planning. For the 0.5 GW of solar under construction, prior efforts they'd made to increase local PD sourcing and diversify their suppliers paid off, combined with the fact these projects are being executed relatively near term. Their wind pipeline in the U.S. also had no impact from recent announcements.
So existing projects are mostly insulated due to prior planning and timing. Where's the uncertainty hitting them then? Is it the future pipeline?
Exactly. The uncertainty primarily impacts projects that are still under development, so pre-final investment decision or FID. For those projects, they are basically pausing and taking a step back. They want to gain more clarity on the future tariff landscape, the long-term trajectory of the IRA itself, and just the general permitting processes, which remain complex in the U.S.
Makes sense to wait for the dust to settle. What about the IRA specifically? Any hints on its future from the call?
They noted that the first draft of the budget reconciliation bill that emerged seemed slightly more constructive than some had perhaps feared, which offers, a sliver of hope for stability. But they're clearly monitoring how that legislation evolves, as it's still very fluid. Nothing's guaranteed.
But despite all that policy uncertainty, is the underlying demand for green energy in the U.S. still there? Did they comment on that?
Oh, yeah, absolutely. They emphasized that customer appetite remains very strong. They gave the example of a preliminary agreement they just signed for up to 300 milliW to a data center in Texas. Big load growth expected.
Right.
Management feels that in many U.S. markets facing significant expected load growth, renewables and battery storage actually have a strategic advantage because they have a much shorter time to market compared to building new gas plants or, obviously, nuclear capacity.
That's a key point, the speed of deployment.
Definitely. And they also highlighted their significant development pipeline outside North America as offering crucial optionality. This came up several times.
How big is that pipeline outside the U.S.?
It's huge. They have a total global pipeline of 115 GW, and a massive 80 GW of that is located outside of North America.
Wow, 80 gigawatts.
Yeah. This gives them real flexibility. They can choose to allocate capital intended perhaps for the U.S. into other established attractive markets if the U.S. environment gets too tricky. They mentioned places like Brazil, the GTC countries, Gulf, Turkey, China, Australia, or India as examples where they have strong positions and pipelines. It basically acts as a natural hedge against localized policy risk.
That global diversification and optionality seems really key to their strategy then.
Mm-hmm.
Interesting point about it being a hedge. There was also discussion about the recent power blackout in the Iberian Peninsula. Did they offer any insights from the call on that event?
Management noted that the root causes will obviously take time to fully investigate, but they used the event as a sort of stark reminder of fundamental needs in our increasingly complex electrical systems.
What kind of needs?
They stressed the vital need for continued investment in the grid itself, improved interconnection between different regions, and crucially, sufficient flexible generation assets.
What kinds of flexible assets are they talking about there? Batteries? Gas?
Both, really. Combined cycle gas turbines, CCGTs, the more efficient ones, combustion gas turbines, CGTs, the faster peaking ones, and properly configured battery storage. They emphasize that these flexible assets are absolutely essential for maintaining security of supply, managing grid frequency and voltage issues, all the things critical for grid stability as more intermittent renewables come online.
Did the blackout impact NG directly?
They reported that NG's personnel, assets, and financials saw no immediate negative impact from the blackout. Their teams managed the situation well, and interestingly, their hydro assets in Portugal actually played a positive role in helping the system recover stability.
Good to hear. Let's look back at the segment performance again. Gas generation, you mentioned, saw organic EBIT down $100 million. What caused that specifically? Was it just lower prices?
The decrease was mainly in Europe. And it wasn't so much current low prices, but the comparison point. In Q1 2024, that segment still benefited significantly from hedges that were locked in way back during the peak of the energy crisis, when prices were extremely high.
Those legacy hedges.
Exactly. Those hedges provided very favorable margins last year. In Q1 2025, those really profitable crisis hedges have largely rolled off. So they are now primarily earning money based on current market conditions for providing flexible power when needed, plus maybe some minimal past carryover. It's essentially a normalization of margins compared to an extraordinary period in Q1 24.
That makes sense. Tough comparison. How about supply and energy management? That segment's EBIT was also down organically by $245 million. Similar story.
Similar headline, but different drivers underneath. Yes, that segment's EBIT was $1,291 million in Q1 2025, down organically. But here, you really need to look at the two main subsegments separately. B2C and B2B energy management.
Okay, let's break it down. B2C first, business to consumer.
Right. B2C EBIT actually grew significantly, up 323 million organically.
Wow, up. Why?
Several factors. It benefited from the colder climate, increasing volumes. There were significant positive timing effects, which management was very clear are expected to reverse later in the year. The market environment allowed for full risk valuation and pricing. And it also just looked strong compared to Q1 2024, which had some negative one-offs, like certain discounts dragging it down.
Okay, so B2C had a very strong quarter, but with some caveats about timing. Was that performance representative of what they expect for the full year?
No, definitely not. Management was very explicit that Q1 2025 was not a normative quarter for B2C EBIT. They pointed out that while Q1 is typically about 40% of B2C volume normally, this year it was exceptionally strong due to those timing effects. They reiterated their expectation for full-year B2C EBIT to be around €500 million.
Okay, so implying a much lower run rate for the rest of the year. What about the other side? B2B, business to business and energy management.
Right. B2B EBIT was down 349 million organically. This was also largely due to timing effects, but actually in the opposite direction compared to B2C.
Opposite timing effects. How does that work?
In Q1 2024, they had a significant positive timing effect of around 500 million linked to winter-summer seasonality and their summer delivery contracts. This year, Q1 2025, that positive effect was much smaller, only around 200 million. Management stressed, again, that this timing effect is expected to fully reverse over the subsequent quarters and has no impact on the full-year B2B earnings expectation. It just makes the quarterly comparison noisy. Energy management EBIT was also down slightly organically, mainly due to lower reserve reversals compared to Q1 last year when market prices fell sharply.
Okay, so a lot of timing noise in Q1 distorted both B2C and B2B in opposite directions, making that direct year-on-year comparison tricky for the segment overall. What does management expect for the full year for this combined B2B and energy management piece?
Despite the Q1 organic decrease driven by these timing effects and reserve reversals compared to an unusual Q1 2024, they felt it was actually a good quarter, in line or maybe slightly above their internal expectations overall. They continue to expect full-year B2B and energy management EBIT at the former GEM scope, basically, to be around $2 billion.
$2 billion for the full year.
Yeah. And they also highlighted the stability of their B2B business in particular, noting that 80% of the 2025 B2B margin is already locked in through multi-year contracts, which provides a pretty resilient base.
It's a high degree of certainty. Okay, let's pull some key insights from the analyst Q&A section. That's often where you get some interesting color. Management was happy with Q1, but also sounded a note of caution. What was that about?
Yes, they were definitely pleased with the Q1 execution. Things went well. But the caution seemed to stem from events that occurred after the end of March, specifically things happening in April. While their overall market exposure is pretty limited because of their hedging policy, they still have some open positions that require careful management in what can still be volatile markets. So, just being prudent.
Right, not getting ahead of themselves. There was a question comparing their energy management trading performance to some peers who have seen, let's say, some underperformance lately. How did they address that comparison?
Yeah, that came up. They acknowledged that some peers have recently missed expectations or even issued warnings. They felt their own Q1 performance in that former GM scope, taking B2B and energy management together, was, I think the term was, quite okay, given the market backdrop.
Quite okay. Not exactly shouting from the rooftops.
No. They noted that energy management itself has become tougher, citing rising costs like European gas transportation tariffs making margins tighter. But they really credited the strength and stability of their B2B business, built on those stable multi-year contracts, as providing significant resilience. They specifically said they expect their B2B business to have a very strong year, much better than last year once you strip out the timing effects. They feel their overall profile in this area is just more resilient than perhaps some peers due to that strong B2B foundation and their generally limited risk appetite in the pure trading part.
Speaking of that risk appetite, they emphasized it's limited. What does that mean in practice for them? Are they taking big directional bets?
No, not really. Their key principle, they stated, is hedging at inception. Essentially locking in margins when a contract is signed or an asset position is taken. They don't run a large proprietary trading book trying to guess market moves.
Okay.
They manage exposure through structured frameworks like value at risk. They are, sure, but they stress they are not a commodity hedge fund. Their market activities are designed to be directly linked to supporting their industrial assets like power plants and serving their customers, not engaging in speculation for its own sake.
Got it. Back to the U.S. for a moment on renewables installed costs, competitiveness, and that IRA political risk. How are they managing costs and uncertainty there, especially with supply chains?
They admitted it's hard to predict future U.S. tariff impacts with certainty, but they pointed again to their proactive supply chain management diversifying sources, increasing localization efforts, which provided a degree of protection for their current U.S. buildout. Globally, they are working closely with suppliers, including forming strategic partnerships, particularly in large volume markets like the Middle East. They also noted that solar panels themselves, outside of the specific U.S. tariff environment, are actually very competitive globally right now.
So the core tech cost isn't the issue outside the U.S. policy specifics. What about the IRA's future? Any more thoughts on that from the Q&A?
They reiterated that the initial budget bill draft was, maybe a bit better than feared, offering some hope for a less disruptive outcome. They acknowledged it will eventually phase out, maybe even slightly earlier than originally planned, perhaps around 2029 based on current talks. However, they made a strong point. Even if the IRA disappeared entirely tomorrow, the market would revert to fundamentals. And those fundamentals, particularly in the U.S., include strong economic growth, driving significant electricity load growth, especially in places like Texas.
Right, data centers, electrification.
Exactly. They also see supply chain limitations for building new gas generation quickly as a factor that actually makes renewables necessary to meet that load growth, regardless of specific incentives. So they believe pragmatism will likely lead to solutions, and that customers ultimately still demand green power, where renewables are increasingly competitive on their own merits in the right locations anyway.
That's a nuanced view. Fundamentals might still drive renewables growth even without the peak IRA support. Quick clarification. Any lingering benefits from those high gas crisis spreads feeding into Q1 gas gen results?
No, they confirmed the sharp decrease in captured spreads compared to Q1 2024, which definitely benefited from those old hedges locked in during the crisis peak. They explicitly stated they are not counting on a hedging backlog anymore. They are primarily earning money from the current market use of their flexible assets with only minimal past carryover. So it's current market reality now.
Okay, clear. On the Belgian nuclear JV, that Chivity closed any intention to sell down their stake now that the deal is done?
No, they stated clearly they have no intention to sell currently. They are committed to operating the assets and properly setting up the JV structure following the recent closing. The focus now is on managing the decommissioning phase safely and efficiently and preparing for the long-term operation aspects of the restarted units.
Got it. More detail on the IRA and batteries, particularly the transferability of tax credits and the battery supply chain, which often involves Chinese components, right? How are they navigating that?
They confirmed they have used the tax credit transferability feature. They find it an interesting addition that provides more market liquidity and financing options, and they are watching how discussions around its potential phase down evolve. On batteries, yes, the origin of components, including Chinese ones, even if assembled elsewhere like the US, is definitely a focus area. They stated they are actively working hard to diversify their battery supply chain globally.
But does that supply chain risk impact their U.S. battery targets? They have a big target, right?
That's a key point they made. Their U.S. battery target, 400 million EBIT by 2027, relies heavily on projects that are already under construction and expected to be completed in 2025. Because they significantly front-loaded the execution of these U.S. battery projects, they feel that specific target has been substantially de-risked from future battery supply chain issues or potential tariff changes. They seemed quite comfortable with their current U.S. battery positioning for hitting that near-term goal.
Good planning again. The dividend policy came up, inevitably. They reaffirmed the current policy, but what about the market's apparent desire for an increase, or even talk of an interim dividend?
They reaffirmed the policy. 65-75% payout ratio on net recurring income with that 1.10 Mero per share floor. They stated, reasonably, that Q1 is too early to decide on the full year 2025 dividend. That decision will happen with the board after the full year results are in.
But do they hint at anything?
They did. They openly acknowledged the market's, I think the word used was impatience to see the dividend start increasing again. And they said their aim is for stable, gentle growth over time, adding this gives you a hint where we'd like to push. So a nudge, nudge, wink, wink, maybe.
Okay, reading between the lines there. What about an interim dividend?
Regarding an interim dividend, they said they have considered it, but noted it's quite complex under French law. It requires cumbersome interim closing processes, and there are stringent restrictions on capacity that make ensuring long-term stability harder if you start paying interims. However, they did say they are open to discussing it further with the market, noting the request seems to be ramping up. So door isn't closed, but it sounds complicated.
Okay, so management hears the market on the dividend trajectory, but practicalities matter. Earlier, you mentioned timing effects in B2C and B2B. Did they actually put a number on those Q1 impacts?
Yes, they quantified it in the Q&A. There was a positive timing effect in B2C of about $100 million in Q1, and there was a negative timing effect in B2B of approximately $200 million in Q1.
And both wash out by year-end.
Correct. Both are expected to fully reverse by the end of the year, netting out to zero impact on the full-year earnings picture. Just quarterly noise.
Any other fine-tuning on full-year guidance assumptions mentioned, like tax rates or financial costs?
Minor things. They mentioned financial cost assumptions saw slight improvement. This was because short-term interest rates decreased a bit later than they had initially expected during the period when they were holding significant cash before the annual dividend payment went out. So a small positive tweak there.
And just to double check on that, 400 million US battery EBIT target by 2027, still solid in their view, despite all the US uncertainty discussion.
Yes, they reiterated they see no significant risk to that specific target. Again, they emphasized that much of that projected value is tied directly to projects already well underway and on track for completion in 2025, where execution is proceeding broadly as planned.
What about M&A and electricity grids? Are they actively pursuing acquisitions there, or is the focus elsewhere?
They stated they are working on leads for a power network acquisition, so yes, it's on the agenda. But they also stressed being agile and value-driven. They aren't cornered into only doing grid deals, meaning if value-accretive opportunities arose in acquiring operating renewables assets, perhaps if market conditions or stress among peers created attractively priced opportunities, they would potentially redeploy capital there too, provided it fits their overall strategy. They want flexibility. They also reminded listeners about their significant organic power network development efforts already happening in places like Chile, Peru, and Brazil.
So build and buy, potentially, across different asset types, driven by value. Any interest expressed in more hydro investments after that Brazil acquisition, perhaps in Europe like France or Germany where concessions might change?
They are definitely interested in potential French regulatory changes that might open up some hydro concessions down the line, but they were cautious, noting the timing is very uncertain and it could be a long-winded political and legal process. What they find very attractive right now is modernizing their existing hydro assets. They mentioned potential in France with their SHM assets and ongoing work in the UK to increase capacity. That avoids needing complex new permits. But yes, the Brazilian acquisition clearly demonstrates their appetite for quality hydro assets where the opportunity makes sense.
Final quick points from the Q&A. B2B customer demand and B2C competition. What's the latest there?
On the B2B side, they said customers, especially the larger industrial ones, are still erring on the cautious side due to the general macro uncertainty out there. However, crucially, 80% of ENGIE's own 2025 B2B margin is already locked in via contracts, providing that stability we discussed.
And B2C.
In B2C, competition is definitely returning, heating up, particularly in regulated markets like Belgium and France, where things had been quieter during the crisis. Their focus now is on remaining competitive on price while making absolutely sure they are correctly pricing in the risks involved.
Balancing act there. All right, that was a really comprehensive deep dive through the call. What's the core message you take away from this ENGIE Q1 2025 update, if you had to boil it down?
I think the core message is one of a solid start to the year, really, both financially and operationally. The results seem to highlight the benefits of their strategic focus on being a simpler, more adaptable company. That integrated model they talk about, linking renewables, networks, flexible power, and customer solutions, they clearly see it as well suited to navigating the energy transition and this pretty dynamic, sometimes uncertain environment.
And that confidence in hitting their full year guidance seems justified based on Q1.
It seems pretty grounded in the Q1 performance and their overall strategic positioning, yes. They feel they have the resilience baked into the portfolio to offset potential headwinds that might pop up in some areas with progress and growth they're seeing elsewhere.
Right.
The proactive measures they took in the U.S. supply chain, the significant operational and geographic optionality built into their massive development pipeline, their unique cash generation profile from the different business types, and of course that major de-risking of the balance sheet from the nuclear deal closure. They see all these as key factors supporting that confidence.
Okay, before we wrap up, it's time for that segment where we entertain some ideas, remembering very clearly that this is purely for discussion and absolutely.
Not financial advice. Never financial advice.
Absolutely. 100% not financial advice. But given the confirmed full-year guidance range, the significant de-risking of the balance sheet with that nuclear deal finally closed, and management repeatedly talking about their flexible capital allocation, and interestingly, their willingness to pursue value-driven M&A, potentially even in operating renewables assets if the pricing is attractive. What slightly outrageous but maybe plausible trade idea could we concoct based purely on the commentary from this call?
All right, okay, if we're just spitballing here, purely hypothetically, you could maybe consider a long position in NG, paired perhaps with a short volatility play on the stock itself.
Okay, long stock, short volo. What's the logic?
Well, the logic would be the combination of those stable, often regulated infrastructure cash flows, they're already locked in B2B margins for a big chunk of the year, and that newly de-risked balance sheet, all that provides a credible floor or stability argument for the share price. Reduces the downside volatility, perhaps.
Right, the stable base. Where does the outrageous part come in?
The outrageous or maybe opportunistic part comes from the possibility that the current acknowledged macro uncertainty and potential stress we're seeing among some pure-play renewable peers could create specific mispriced M&A opportunities for acquiring good quality operating renewables assets. And NG, with its strong balance sheet, stated optionality, and integrated model, might be uniquely positioned to jump on such deals if they arise at attractive prices.
So betting on them finding a bargain due to others' woes?
Kind of. This potential catalyst for growth or value creation from opportunistic M&A might not be fully reflected in the current valuation. So you'd be looking for that stability, plus a potential upside surprise from smart capital deployment, which could be unlocked if those specific conditions arise. That's the angle.
That's definitely leaning hard into the optionality and balance sheet strength themes they discussed on the call. Again, purely hypothetical, not a recommendation by any stretch.
Precisely. This is not financial advice. Please don't trade based on this.
So we've taken a deep dive into NG's Q1 2025 earnings call, pulling out the key results, digging into the financial nuances, looking at the strategic moves, and getting a sense of management's perspective on the market and their business.
Yeah, we've seen a company reporting a pretty solid quarter overall, navigating some complex external factors like the U.S. situation, clearly executing on their strategy like the nuclear deal and renewables build-out, and projecting confidence in its path forward, underpinned by that balance sheet strength and operational flexibility.
For you, the listener, here's a final provocative thought to maybe leave you with, building on what we've discussed today. Consider how a company like NG, with its really diverse operations across different technologies, and crucially, that extensive global pipeline, much of it outside its core European base, how that might fundamentally change its exposure to localized political risks, like IRA uncertainty or specific market risks, compared to peers who are perhaps more concentrated geographically or technologically. What does that unique level of operational and geographic optionality imply about how you might assess the long-term value and resilience of diversified energy players like this one going forward? Something to chew on.
And as always, one last time, please remember, this was not financial advice.
Thanks for joining us for this deep dive. We hope this conversation helps you better understand the key takeaways from NG's Q1 2025 earnings call. Feel free to explore the points discussed further on your own.